Bogged down by paperwork and manual processes, financial institutions struggled with inefficiencies, delays and risks that cost billions each year. But with the rise of digital technology, the landscape has changed. Today's platforms offer real-time visibility across global markets with AI-powered analytics that once took teams of specialists days to compile. Blockchain and smart contracts have revolutionized transaction security and speed, cutting settlement times from days to minutes. Regulatory compliance that once required mountains of documentation now flows through streamlined automated reporting systems. Cloud infrastructure connects counterparties globally, creating efficient, low-risk collateral pools, all resulting in reduced risk, lower costs, and efficiency like never before. In collateral management, digital isn't just the future, it's already here. Is your collateral management keeping pace with the digital revolution?
Hello, I'm Nadine Shakar, Global Head of DTCC Digital Assets. Thank you so much for joining us today and welcome to the Great Collateral Experiment. Our objective at DTCC is to break down the digital barrier by bringing the industry together to accelerate the adoption of digital technologies. We chose to lead with collateral infrastructure by making it the first application on our institutional financial app chain. Why collateral infrastructure? Well, we think collateral management is the perfect killer application for blockchain. We have all witnessed the recent market volatility and liquidity challenges, which have underscored the criticality of resilience across global financial markets. Even in the US Treasury bond market, we've seen the continued shift towards the safe haven of clearing. FIC volumes reached an all-time high of over $11 trillion on April 9th. The move to digital collateral has never been more relevant in playing a critical role in enhancing liquidity and strengthening resilience and soundness of the financial markets. It is well known that collateral is a multifaceted ecosystem with complexity growing each year. Major challenges include a fragmented market infrastructure, inventory trapped by region and product, lengthy settlement cycle, a growing regulatory burden, and an ever-growing cost base. Operational technology inefficiencies, from siloed to stale data to unscalable duplicative processes, create delays, high collateral buffers, and a direct profit impact. So what about the new world? Distributed ledger technologies have changed the game for settlement speed and security, reducing timing from days to minutes. A revolutionary approach to data and smart contracts enables seamless connectivity across continent and products, creating truly holistic global collateral pools. Our goal now is to find common ground for a unified digital collateral infrastructure for the entire industry, and we believe that an open, interoperable approach to this new infrastructure is the best path forward as both the technology and global regulations continue to evolve. Our collateral app chain enables financial institutions to tokenize assets using any tokenization capability and issue assets onto any network, private or public, while remaining seamlessly integrated with TradFi market infrastructure. Today, we will demonstrate 24 hours of global collateral movement via a digital operating model. We will showcase the ability to finance real-world and crypto assets with various types of collaterals via tokenized assets, DLT solutions, and smart contracts. Please note, however, that all the scenarios, movements, and transactions described are fictional, if not inspired in some cases by real-world events. And all the data used is synthetic data from the DTCC Launchpad. Launchpad is the DTCC sandbox in the nucleus of the digital market infrastructure ecosystem. We don't intend for this to be a strictly technology demonstration. Our goal is to showcase smart automation that realizes the benefits of digital collateral infrastructure, including liquidity, significant cost efficiencies, operational scalability, and enhanced resilience. I do want to be clear that this is a platform to facilitate the execution and settlement of market strategies at scale. DTCC is not offering a collateral management nor a tri-party offering. Our whole objective for today is to show how digital technology makes collateral management faster, better, and more efficient. Today, we begin our journey towards adoption and scale. The future is now. As we conclude, we recognize that not all questions will be answered, and additional questions may arise. That is acceptable, and further work is needed on jurisdictional recognition, compliance clarity, data, infrastructure, and risk frameworks. We also welcome, actually encourage your questions and observation feedback, which you can input in the box below your screen. While we will not respond to all your questions live, we will respond and post them on our website. The data and feedback derived from the experiment today will inform our next steps. We will approach this as an industry collaboratively as we strive towards production at scale. This is not an exclusive DTCC product. This is an industry application designed to facilitate the adoption of digital technologies and reimagine the art of collateral management. We have designed the experiment to inform, to educate, and reveal the art of the possible. To facilitate the introduction of this new framework, we've established a frictional bank called MrConectr. During the next hour and a half, we will simulate a 24-hour clock, showing events that significantly affect the bank's balance sheet, liquidity, and operational risk and performance. So now it is with great pleasure that I introduce our team. Dan Doney, CTO and Chief Architect of DTCC Digital Assets, who today will play the role of the CTO of MrConectr. Yeleni Iswaran, responsible for DTCC's Digital Asset Launchpad, and Joe Spiro, Lead Digital Collateral Product Strategy, will play the role of MrConectr's collateral managers across multiple jurisdictions. Chris Watts, CEO of Tonic Consultancy, who will act as our moderator and also assume the role of the CEO of MrConectr. John Vinci, DTCC Head of Secured Funding, who plays the role of the Global Treasurer for MrConectr. In collateral, digital isn't the future, it is the present. This is an opportunity for us as an industry to reimagine collateral management. Let's shape it together. And now I hand over to Chris Watts to provide some industry insights on the collateral landscape.
Thank you so much, Nadine. Hello, everyone. I'm Chris Watts, CEO of Tonic, an expertise-led capital markets consultancy. I am super excited to be here today alongside DTCC for such a groundbreaking event. Both myself and Tonic have executed major transformation across the collateral industry for a long time now, bringing liquidity, operational and cost efficiencies for our clients. But what we're going to see today is a real game changer. I don't say that lightly. The reality is, despite major progress in recent decades, we will never be able to fully unwind the inefficiencies of the TradFi world. In a climate of ever-increasing complexity and stress, now is the time to pivot towards superior solutions. And we believe this comes in the form of digital. For us collateral nerds out there, the digital collateral use case is super strong. The ability to shortcut major collateral TradFi constraints really is the holy grail us collateralites have been searching for. Now, you may have seen a myriad of digital collateral proofs of concept playing out across the industry. The difference today, and with the great collateral experiment, is that we've not previously seen anything near this scale or level of completeness. Importantly, as mentioned by Nadine, the experiment is also driven by the industry with direct market participation throughout. As for today, we're going to focus more on the how via a practical demonstration of DTCC's digital app chain model. But before we do, let's go one level deeper on the headline benefits in play for digital collateral. As of right now, digital technology is already transforming how assets are issued, valued, and exchanged. Mobility. Blockchain and smart contracts have revolutionized transaction speed and security, reducing settlement times from days to minutes. 24/7 settlement windows are being opened up. Regional market obstacles are being removed. Real-time global collateral pools are being created, enabling maximum liquidity, mobility, and optimization. Imagine a world where an asset moves fluidly from one continent to another with no restriction on settlement windows, regions, or product silos. How lovely would that be? Collateral operations becomes a highly scalable and resilient function within the digital ecosystem, achieved via near real-time data, standardized and centralized, which in turn enables end-to-end process automation. Now, you may have noticed a little bit of global volatility in recent weeks. The automation and scale provided by digital collateral will help protect us all from volume surges that come as part of a long-term stress climate that now seems, I'm afraid, our new normal. Not to mention the extensive cost savings activated by digital collateral across funding, operations, and technology streams. Especially important in the tough cost environment we find ourselves. A major outcome here is the reduction of today's expensive collateral buffers, used as an insurance policy against the inefficiencies of the old world. The end result for the digital collateral operating model, a transformational set of market benefits, unprecedented liquidity, efficiencies, scale, and speed. Now, over the next hour and a half, we are going to travel a virtual 24 hours together across the entire world. That's right, we'll be replicating a global working day, moving between some of the best cities on this planet. Within each location, we'll show how a fictional global bank can manage collateral across multiple real-life scenarios, leveraging that digital collateral operating model. So where are we going? Well, we'll start our day in Japan with CCP trading and margining of crypto derivatives, maybe followed by some late-night sushi. We'll then jet across to Paris, grabbing a croissant for breakfast, whilst collateralizing OTC derivatives under the uncleared margin regulations. After that, a quick pit stop in London for a bacon butty, followed by some extreme repo collateral management. There are rumours that a UK stress event is brewing. Sounds familiar. Then we have our big finish in the Big Apple for intraday repo, crypto collateral assets, and inter-CCP collateral. And some sleep, maybe? A very sexy set of scenarios indeed. Not often that collateral and sexy get mentioned in the same sentence, but I'm sure you'll agree it certainly applies here. In parallel, our margin core SMEs will walk through the respective collateral app chain features under each scenario. Now, bear with me a second. Hello, delightful to meet you all. Now, you're probably wondering who I am. Well, you'll be really surprised to hear that I'm still Chris Watts, just wearing a very clever disguise. I got you, didn't I? Because from this point onwards, I am CEO for Margin Core Bank, a high-performing multinational institution, albeit a fictional one. Now, I'm very, very proud of Margin Core's success, mainly driven by me, I humbly say, and our long-term strategy, highly focused on optimizing capital and liquidity worldwide. Today, we're going to bring our strategy to life for all of you here via the Great Collateral Experiment. But before we do, I want to introduce you to someone very important, Dan Doney. For today at least, Dan will be CTO of Margin Core. We will stick to this script. Dan will be sharing more on what makes Margin Core's digital collateral platform so special. Dan, over to you, sir.
Thanks, Chris. Hi, guys. I'm Dan Doney. For one day only, I am indeed CTO of Margin Core. Unfortunately, no pay raise. The collateral app chain makes my life easy, and that's saying a lot for a CTO. It gives my traders a single platform to interact with any form of value in any jurisdiction, 24/7. An app chain is a layer 2 blockchain network designed for performance and privacy in the execution of complex transactions. It's gasless, meaning there are no fees for transactions, and can be connected to any ledger, including public and private layer 1 DLTs and traditional custodial systems. Since the app chain is built on Hyperledger Besu, an open source EVM-based ledger, my developers can spin up their own networks for development and testing. And we can leverage the innovation from smart contracts developed for DeFi and crypto use cases. Since the app chain can bridge to any legacy system, it provides a single touch point for the movement of all value. One integration to rule them all. The openness of the app chain allows me to use any wallet or custody provider. Here, some of our team is using Blockdaemon, while others are using Fireblocks. I love the flexibility and resilience. For operations requiring the highest level of security, we use GK8, a hardware wallet, but we're free to choose from any wallet solution we prefer, guaranteeing that we aren't locked in as markets evolve. Also, the collateral capabilities work with nearly any tokenization protocol, so we can leverage existing investments and partnerships. This is wild. In one platform, my traders are able to leverage Circle's USDC stablecoin, Wellington's Ultra money market fund, issued via Libera's tokenization platform, and SocGen's tokens, representing a range of cash and securities. But the real magic is the conversion order. This allows my team to get real-time mobility from traditional assets, 24/7. A conversion order is a trade that converts value in traditional custodial systems to digital form and back again, so that it can move on unified rails and trade and settle in real time. My traders love that they can access any form of value, cash, treasuries, funds, equity and debt securities, and even crypto from the same rails. I love that my corporate policies are enforced automatically, so they can only execute transactions that are compliant in each of our global markets. Using Onera's technology, the app chain connects to other distributed ledgers like Canton, public and private Ethereum, Finality's Layer 1, and more. The hub and spoke model of the app chain allows me to focus a single point of integration to accelerate my modernization plans. I'm most impressed with the trade automation made possible by account abstractions, an advanced EVM process enabling smart contract wallets that automate the collateral lifecycle. This allows my traders to execute complex transactions across markets that clear and settle in minutes. They can move collateral directly between agreements, across markets, custodians, and tri-party agents, allowing us to efficiently use our balance sheet and eliminating the need to pre-position value or needlessly move it before corporate actions. The on-chain data framework allows consistent and transparent valuation, reference data management, and rules enforcement. The end result is transformational for our collateral operations. So you can track along with my traders as they work through a challenging day in the markets, which seems to happen all the time lately. Let me give you a quick tour of the platform to see how it works. Welcome to the Institutional Finance app chain. All you need to get started is a web browser and your favorite wallet. It seems like features come weekly for the app chain. I'd hear advanced charting and even lending are next. The app chain includes a series of utilities for institutional finance. Dynamic pricing, haircuts, interest rates through oracles are just an example. It includes a set of compliance and data capabilities to enable me to manage risk and reference data. Of course, there's tokenization. We can see all the stars of today's show in one place. This allows me to drill in for reference data and allows my traders to act on the tokens themselves so that the reference data permits us to manage the collateral operations. But we're here for collateral. There are capabilities for all three institutional collateral roles. Providers, that's borrowers, receivers, that's lenders, and tri-party agents. We'll spend most of our time in the provider's net asset pool, a set of tools centered around the daily activities of a collateral trader. The net asset pool, also known as a trader's long box, provides netting of all assets, collateralized trades, and management of locked and collateral value. The net asset pool is a smart contract account abstraction. The account abstraction enables interactions with other smart contracts, like the collateral agreements and also the tokens, which are, of course, smart contracts as well. It includes all the functions a trader needs to allocate and recall collateral, substituting as needed, and optimizing the collateral according to changing conditions. You'll see the traders avail themselves of these buttons during their day. I can see my wallet, the blockchain conditions. Remember, the app chain is gasless. And analysts can select whatever currency is best for their local market. Remember, we're a global firm, so traders love seeing their exposures in local currencies. These are my net positions across all of my collateral agreements. Check this out. I can operate any form of value from one location. Here I've got tokens that represent cash, crypto, alternative assets, public and private securities. I can look at each of my collateral obligations. For the first time, from one place, I can manage all my agreements across tri-party agents and CCPs. Even more exciting, I can move value directly between the custodians in seconds. Let's drill into a collateral agreement. Here we can look into the details, view locked assets, and respond to margin calls if needed. This also lets me check the configuration and terms of the collateral agreement. But here's a page that I really love. Conversion orders. Conversion orders are the bridge between TradFi and DeFi. From this one screen, I can manage my assets, whether they're in digital form or traditional, and convert between each. You can see I can see my balances on-chain and in the depository. Let's execute a conversion order. We'll move 5,000 shares of Apple from the DTC repository to my wallet. Now this transaction takes about a minute. While the value moves, let me explain what's happening behind the scenes. First, I'm executing a delivery order. The platform executes a delivery order in DTCC. This is moving value from my traditional DTC account to a control account. And its digital twin is then issued on-chain and delivered to my wallet. This allows me to move the converted value and engage in collateral operations at any time of day. The securities remain in the traditional system, while the entitlement transfers between parties on digital rails under the principles of good control. I can look at the convertible assets linked to any custodian. I can manage my balances and convert value between forms in real time. Once the value is moved to the app chain, it can be used on common rails. In addition to converting between TradFi and DeFi, using Onera's platform integrated with the app chain just last month, I can bridge value between various DLTs and the app chain. Here you can see Canton, external private ledgers, public Ethereum, and other ledgers as well. I can also take traditional accounting systems and move value from there to the app chain for activity. For me, rather than integrating my systems with a range of custodians and emerging L1 solutions, I have a single point of integration and tools to move any form of value anywhere. Here's the bottom line for my traders. This platform gives the speed and liquidity they want, and for me, it provides the transparency and compliance I need. Let's see if the traders can handle the curveballs this crazy day throws at them. Back to you, boss.
Love that, Dan. Awesome first walkthrough. That chap has some real potential, right? Lots of digital terminology and concepts shared, which may be new to some of you. From app chain to net asset pools, conversion orders. I have to say, I am a big fan of the conversion order. Instant tokenization of real-world assets is not only super cool, but disrupts the whole market in an incredibly positive way. But this is the new world, so please don't worry if you didn't keep up with everything that Dan's just shared, because now we have our great collateral experiment. Here we will show and tell how Margin Call practically applies each of those digital concepts that Dan's just seeded. We'll even do screen share. We'll show you the detail beneath those screens within the new world. We also have some new faces to help take us on our journey, including Yarni Iswaran and Joe Spiro. As Nadine mentioned, these very, very capable folk are Margin Call's senior collateral managers. They work hand in hand with the collateral trading or optimization desk and are responsible for the operational execution of our end-to-end margin workflow globally on the platform that I gave them, remember? So let's get stuck in. Buckle up as we land in Tokyo for our first collateral scenario.
In our first scenario, we show how on-chain collateral management can improve funding costs and efficiency for banks. In our current state, If MarginCore Tokyo is unable to cover their collateral requirement with a central counterparty using their own inventory, they would need to raise collateral in the repo market or use cash, which would increase intraday liquidity pressure and capital costs. As they evaluate their options, they are unable to access the US inventory in the APAC time zone since the US market is currently closed. MarginCore also has crypto futures positions managed by an additional operations team on a separate platform, creating a bifurcated collateral operating model.
In the digital state, it is possible to access inventory from their US branch outside of US market hours to support their obligations in the Tokyo time zone. And the net asset pool allows them to manage their inventory across both traditional and DeFi markets using a single platform and team, bringing significant operational efficiencies.
Let's begin.
Morning, I'm Yalini and I'm the Head of Collateral Management for MarginCore in Tokyo. My role is to help us identify opportunities to optimize MarginCore's collateral processes, managing risk while reducing funding costs. As Dan mentioned, we've recently transitioned the collateral team to a blockchain solution, the Collateral App Chain, and this has significantly improved our efficiency and given us options we've never had before and better, more timely information so I can make more informed decisions. Our boards recently allowed us to expand our asset classes to include cryptocurrencies, specifically Bitcoin, and this platform has allowed us to manage crypto alongside our traditional assets, reducing our time to market and any enhancements to the platform, and that's a huge win. The markets are proving volatile again today. We've been having more trades move to clearing, and I'm expecting intraday calls from our clearinghouse. We've also been hitting our limits on JGBs recently, and while I would typically go to the repo markets to raise cash, it's just not ideal, but thankfully I've got options today. Let's look at our positions. I can see we've had a call from JSCC this morning, and I know that we're not going to be able to use JGBs to cover any of that. But luckily, I can tap into our global inventory through our conversion order service on the app chain. I have access to both our traditional depositories as well as our distributed ledgers. But I know that our US broker-dealer left us with some treasury inventory before they left last night. And what I can do is create a bit of a buffer for us to make sure we cover through the day. I'm going to convert around 190 million in quantity and assign that to my wallet. Now, the great thing about this is we can maintain the safekeeping of the underlying asset in the local market, but still utilize the full collateral value in the APAC time zone. Now, as I can see that's in my wallet, I can allocate the collateral and to JSCC. But while I do that, let's hear from my friends at JSCC on their digital plans.
JSCC is part of the Japan Exchange Group, JPX, and is a Japanese clearinghouse for the cash equity, listed and OTC derivatives, and OTC JGB repo financial market. As a clearinghouse, we are primarily responsible for reducing concentrated market risks, and it is essential our collateral management processes are robust and highly efficient so that our clearing members can optimally fulfill their margin calls and the process occurs without operational failure. We see many benefits from a transition to DLT, both for clients and for JSCC. We have been exploring digital asset models to improve collateral processing and optimization in Japan. Because more than 70% of JSCC cleared volumes originate from overseas players, we can see significant opportunities by leveraging interoperability with global market infrastructure peers. Other APAC markets are also growing quickly, and access to international liquidity can further improve efficiency in this region.
The Collateral App Chain has given us the ability to act with the utmost urgency during these more difficult times, and the speed at which I can deliver collateral to CCPs versus a more traditional CCP margin model is incomparable, as in we're able to allocate in minutes versus days. The other benefit of the app chain is that it's allowed my team to leverage this new operating model to scale across new asset classes. We're currently managing a crypto futures trade, and the reason we're able to extend this capability is due to the customization of the smart contract. Now, we can see all of the contractual details related to this agreement within this smart contract. But the main difference is that we're managing crypto versus traditional is the fact that we're managing against risk of a much more volatile underlying asset, and the margin calls are managed against a target ratio. In this case, it's 1.4, and my default ratio is 1.1, which means that I'll be liquidated if we're unable to cover this exposure. The real-time nature of this market brings more risk, but I can monitor in real time and use more stable assets as collateral to mitigate against this risk. In this case, I'm going to use stablecoin to cover the exposure. I'm currently holding USDC in my pool, and I can earn some yield when I pledge this. So I'm going to allocate 39 million in quantity. And as soon as I hit allocate, the transaction settles and I'm able to run down my deficit. So far today, I've been able to not only source US collateral before the US market opens, I've also been able to settle collateral with my CCP in real time and manage the volatility of crypto assets with just better risk management capabilities than I've ever been able to have before with more traditional collateral processes. My main benefit is that all assets are now in scope, and I can move them as quickly as the network I'm settling collateral on allows. With the continuing market volatility, maintaining our cash reserves and HQLA buffer will help us support liquidity through the rest of the day. Mr. Watts, we've saved you some cash. Hope the rest of your day goes well.
She is D-I-S-C-O.
Mr. Watts?
D-I-S-C-O. Arigato, Yalini-san. Very cool indeed. Very cool. And I heard cash. I do like cash a lot. But what are the outcomes our digital app chain has given us here? Number one, liquidity. Here we mobilize US Treasuries to Tokyo in real time with no settlement or market constraints. So if we're short of a specific asset type, we now have a global liquidity pool to mobilize from 24/7. Number two, cost and profit growth. Our collateral buffers have come down hugely thanks to that same real-time liquidity pool. In turn, this frees up large asset balances for investment returns. We're now making substantial cost savings over the course of a year. Significant profit growth for Margin Core, significant bonus growth for yours truly. Number three, scale. We've started to only scratch the surface here of the huge operational gains that smart contracts enable. And here we focused on near real-time inventory management and settlement automation. We've also avoided an external repo trade and the extra ops effort and settlement risk that brings. At Margin Core, we will continue to grow via expansion of our trading strategies, so operational scalability is a hard requirement. Now, the European markets are starting to wake up, so let's jet across to our friends at Margin Core Paris. We don't want to miss out. A bientôt.
In our second scenario, we see how tokenization can create operational and cost efficiency for segregated initial margin under uncleared margin rules, or UMR for short. The multitude of accounts and custodians involved creates inefficiencies in the way inventory is managed. Margin Core Paris starts the day with a deficit in their agreement with Wellington. Margin Core Paris also has excess collateral in their agreement with SocGen. In an ideal state, Margin Core could directly reallocate their collateral across agreements to balance their excesses and deficits, fully optimizing their collateral movements. However, that can't work for several reasons. Mainly, collateral movements may not be processed until the end of the day, meaning that capital returned from an excess can't immediately be pledged to a deficit, and movements across collateral agents are inefficient. Therefore, Margin Corp's treasury must raise additional capital to satisfy the deficit in the Wellington Agreement, not being able to take advantage of their excess collateral positions that will be returned to them too late.
Now, the ideal state is achieved in the digital state, where a single asset pool, regardless of collateral agent, allows for improved optimization, including the option of connecting to tri-party agents. The return from SocGen is delivered immediately, removing the need for Treasury to fund the deficit with Wellington. Two-way margin can be delivered in real time by either party, enabling quick and transparent settlement. Additionally, tokenization allows for the automatic distribution of coupon payments, eliminating the need for substitutions over income events.
Let's see how this looks in the real world.
Bonjour, bienvenue à Paris. Hello and welcome to Paris. One of the primary responsibilities of our collateral operations team here at Margin Corp Paris is managing our uncleared OTC margin activities, otherwise known as UMR. One important aspect of the UMR process is that the collateral must be held in a segregated custody account with no rehypothecation allowed. Also, the requirement to post collateral for IM applies to both parties to the agreement at the same time in both directions with no netting. Before we can move collateral for UMR, we have to confirm all of our initial margin calcs have run. Then we issue any necessary calls and respond to any incoming calls from the counterparties. Based on the agreed amounts from those calls, we calculate and send our RQV to our tri-party agent. The RQV is the required collateral amount. Now, that whole process of calculating the RQV and sending it to the tri-party agent has been pretty efficient. And when we implemented this new collateral app chain, I was wondering how it would impact that whole process. But actually, our app chain can receive all that RQV data directly from our tri-party agent. So there was no need for us to change any of that existing process. I'm looking in our net asset pool, and I can see that those RQVs have already been received into the app chain. Here I can see the resulting excesses and deficits that we need to action. From this provider screen, I can focus on the agreements where we are the collateral provider in the UMR relationship. In this example, we can see our exposure with SocGen is currently over-collateralized, and we have a deficit in the agreement with Wellington. Let's look at that deficit first. I need to post an additional 8.8 million euro worth of collateral. So I'll use the allocate function to see what's available. It looks like I've got nothing available to pledge. This allocate screen shows me all of the assets in the net asset pool that are eligible for this agreement, and it's showing me that they are all fully allocated. Now, of course, we could ask the repo desk to finance some additional assets, but that's not very efficient. It takes time from the ops team and the traders, and there's a big funding cost. Let's see about another option. Back in my net asset pool view, I can see that I have an excess here in the agreement with SocGen. Now, this agreement is managed by a different tri-party agent than the Wellington agreement. I can see the SocGen agreement is managed by BNY, whereas the Wellington agreement is managed by Euroclear. So it used to be really difficult and time-consuming if I needed to move assets from one to the other. But another great thing about this new collateral app chain that we're using now is that all of our assets, regardless of their location, can be utilized from the net asset pool. So in this case, it's easy to recall assets from an agreement with excess, which can then be used to cover the obligation in an agreement with a deficit. I'll select the recall action to see what assets I'm able to pull back. All right, let's see. I have a treasury bill, I have some equities, I have some French bonds. Well, I could recall any of these, but which one should I recall? Which of these would also be eligible for the other agreement? Well, fortunately, I don't have to sit here and try to manually figure it out. Our collateral agent, BNY in this case, can run a collateral optimization so we know we're always allocating collateral to all counterparties in the most cost-efficient manner.
To facilitate optimal outcomes for funding and liquidity, and keeping assets safe and readily accessible in times of stress, We offer a range of optimization solutions to meet diverse client needs, covering tri-party, bilateral, and clear transactions across different collateral venues. In this specific use case, leveraging BNY's optimization and directed allocation solutions, Margin Core Paris would instruct inventory movements from their digital net asset pool to collateralize their margin calls. Integrating digital asset use cases into the network effect that tri-party offers helps clients leverage efficient collateral solutions, the impact of which only increases as tokenization enables more efficient utilization of assets.
Now that the optimization routine has run, I can see that the excess in the SocGen agreement has been flattened, and the asset has been recalled and pledged to the Wellington agreement to cover that deficit. So both of these agreements are now in great shape for the day. Now, these two collateral arrangements show where we at Margin Core are the collateral provider. Since UMR is a two-way requirement, we also have arrangements with these two counterparties in which we are the collateral receiver. From the receiver menu, I can focus on these two agreements. Here I can see that our Wellington agreement is just about flat for the day, so no need for them to move any collateral. But our SocGen agreement has a deficit. It looks like SocGen needs to post additional collateral today. Tom Sullivan from SocGen, are you there?
Hey Joe, how you doing today?
I'm doing great, Tom. How are you?
Awesome, thanks.
It looks like you owe me some collateral today.
Yeah, I can see that. It looks like we owe there's 2 million calls in euro. So what I think I'm going to do is I think I'm going to pledge our euro stablecoin, the EURCV. So it's really great that we can use this collateral app and the interoperability that it affords to allow us to use assets that are tokenized on other chains. And it was really easy to deploy the EURCV on the app chain. And since we've agreed it's eligible collateral for this agreement, we can now use it to cover our exposure. So I'm going to go into the allocate function. Okay. Voila. So here's a little bit more information about our EURCV coin. I'm Tom Sullivan, Head of Business Development for Digital Assets at SocGen in New York. I'm excited to talk about our stablecoin that was issued by SG Forge in 2023, EURCV, also known as Coinvertible. The Coinvertible stablecoin was issued with the main purpose of driving capital markets activities on chain. It was issued on the Ethereum blockchain in 2023, and in 2024 it became MiCA compliant. Along the way, SG Forge has established a number of milestones, including becoming one of the first banks to become a virtual asset service provider in Europe and to be able to support the MiCA rules. When MiCA went live in 2024, it was fully MiCA compliant, and it also became fully transferable on the Ethereum blockchain. Since then, it will now be available on several other blockchains, including Solana, Ripple, and Stellar. And we're looking forward to being able to use it as a means of cash and as a means of collateral using in this project.
All right, Tom, I see that the collateral movement that you just processed has already settled and our exposure is covered. That's amazing. You entered a movement on your side, and since we're using the same distributed ledger, I saw it update instantly within a matter of seconds, and my exposure is completely covered.
Joe, thanks so much. I mean, this has been so easy to do, and it's one of those things that when think about all the time and effort we've spent in the past trying to find the right assets and to be able to deploy them and move them around and make sure that we have our assets reconciled, and to be able to do this so easily, it's just a breeze. So thanks so much.
Thank you, Tom. Back in our Wellington agreement now, it looks like some of the previously allocated collateral is paying a coupon today. This used to be such a pain point for my team. If a coupon paid while the asset was pledged out, it was a nightmare to get that cash back to where it needed to be. So to avoid that situation, we would always do a substitution before the record date where we would pull that asset back and replace it with something else. And we'd have to make sure the new asset wasn't paying a coupon anytime soon so we could avoid having to do this all over again constantly. It was really a very inefficient and manual process. That's another thing that's been so great about this new Collateral app chain. These tokenized assets are smart contracts that have embedded corporate action processes. So even if those assets are pledged out when the coupon pays, those cash distributions can be automatically distributed right back to MarginCore's wallet. We can look to our LedgerScan record to see that cash activity. LedgerScan is a really cool new tool. Here's our CTO, the brilliant and enigmatic Dan Doney, to tell us a little more about LedgerScan.
So now I'm an enigma. Try saying that 3 times fast. We use LedgerScan to track and reconcile activity on DLTs and traditional systems. LedgerScan enriches this activity real time with pricing and KYC information. The platform consolidates on-chain and off-chain data by tracking token and wallet activity across blockchains. It provides APIs for easy integration with my accounting systems. Now I have a single tool to bring all of my trading activity together for a comprehensive view of positions and risk. Like my traders say, real-time insights for smarter decision-making. Corporate actions, like the dividend distribution we just witnessed, are the bane of institutional finance. They require integration across dozens of systems, management of uncertain data, and are often characterized by slow and inefficient processes, especially for alternative assets. But tokens that streamlined dividend distributions and smart contract automated collateral processes know the beneficial owner and allow transactions that took days, weeks, and sometimes even months to execute now move in real time. What used to be a nightmare is now a dream. Now let's take a look at the movement of cash from the dividend distribution on LedgerScan. This is the LedgerScan user interface. It allows me to track all the on-chain activity of my analysts, the movement of value. Here you can see the wallet activity of our trading desk. This allows me to keep tabs on their actions. Now let's look at some tokens. As you can see, we can see value across distributed ledgers and its movement and activity in real time. I can see public and private distributed ledgers together. Here's Benji. Benji is a money market fund that spans multiple distributed ledgers. We can keep tabs on any ledger, the activity of the Benji fund. Benji's pegged to the US dollar, and I can see its movement in real time and distribution across wallets. But we're here to track the movement of the US dollar distribution. Here's the Finality token and its activity. Of course, Finality is worth $1, the USDF token, which is a synthetic central bank digital currency. We can see the dividend distribution and all of its movement between wallets in real time. All of this makes data management a breeze. I'm starting to wonder if they even need a CTO, but don't tell my boss. At least the traders still like me, right, Joe? Don't answer that question. Back over to you.
Thanks, Dan. Yeah, I can see that dividend has been processed, and looking in my digital wallet view, I can see the cash is here, so it worked exactly as expected. And I didn't even have to do anything. So you can see that using tokenized assets in our Collateral app chain has been an absolute game changer for my Collateral team. I mean, look at what it did just today. It helped me maximize my collateral efficiency by taking all the friction out of moving assets between tri-party agents. It allowed my counterparty to interoperably use their own tokens from a different chain to cover my exposure in a matter of seconds. And it eliminated any need for me to waste time on pointless substitutions by allocating the coupon distribution right back to my wallet automatically. I'd say that's a pretty good day. Wouldn't you, Mr. Watts?
I can't get no.
Mr. Watts.
That is, pardon, Monsieur Joe. Pardon, Monsieur. Now, that French accent's coming along real nice, sir. Très bien indeed. Let's remind ourselves of the key outcomes here. Number one, liquidity and cost. Here we've shown we can instantly mobilize return collateral assets to meet other obligations same day across regional markets. In parallel, we've removed the need for internal treasury funding and any external trading costs. Number two, scale. Again, we've displayed here major operational efficiencies across our subs workflow and dividends processing. Today, we are supported by fewer financial and human resources, yet able to handle higher volumes than ever. Number three, Interoperability. We saw a large number of players in this scenario. Dealer banks, buy-sides, tri-party agents, all leveraging the same AppChain platform. The platform's interoperability is a huge plus for us at MarginCore, enabling us to interact with any trading partner, service provider, or technology vendor via a single global operating model. Now, London's waking up, and I've heard things are looking a little rocky. I'm going to jump onto a quick Eurostar. My bacon butty awaits.
Our third scenario demonstrates the benefits of using tokenized collateral under stressed credit conditions. The day begins with MarginCore covering their exposures across repo and margin trades. What starts as a routine process quickly becomes a problem, as a sudden shock to global financial markets results in gilt prices falling. MarginCore London requires real-time changes to their eligible collateral terms to support continued liquidity in the market.
In the digital state, we show how the inclusion of smart contracts and tokenized money market funds can help counterparties navigate a stress event more efficiently. With real-time changes to the collateral schedule, tokenized money market funds can be delivered and received by market participants with near instantaneous settlement, bypassing prohibitive redemption and subscription traditional processes. The result is seamless collateral coverage, mitigating risk and eliminating the need to redeem money market funds for cash collateral. Additionally, managing on-chain collateral in a default can further reduce counterparty credit risk and improve liquidity. Blockchain's immutable and transparent nature allows MarginCore London and its tri-party agents to track positions with a high level of confidence that the being managed fairly and accurately, improving risk management decision-making.
It's now noon in London, and MarginCore's traders are hearing some bad news.
Hi, it's been a tricky day. Our desk is mainly responsible for financing MarginCore's gilt book, and as of this morning, our positions are covered, but
rumors of Britannia Bank's potential demise is causing shock and panic among traders. The century-old UK bank is facing insolvency, and market tensions are mounting over its significant UK bond holdings.
We're seeing unprecedented volatility in UK bond markets today following an earlier announcement that Britannia Bank is declaring insolvency.
Given the volatility in UK markets today, my risk team is advising that we diversify away from UK debt. Our counterparties have been struggling to cover their calls with us, and we're working through our playbook from the gilt crisis a couple of years ago. We know they're not insolvent. I'm going to give Evan Crosby at Wellington a call. Evan, are you there?
I am. Thanks for calling. Unfortunately, we've missed our redemption cutoffs to cash out of money market funds today. I know we previously discussed including Wellington's on-chain funds within the eligible collateral schedule. I'm holding Ultra tokens in our wallet. Would you accept those?
Yeah, I think that's a good call. My risk team have already given me the go-ahead on digital money market funds, so I think I can make the change to the collateral schedule right away. Please hold, I'll be right back. Now, the great thing about managing collateral on smart contracts is that we can make a change with almost immediate effect. Just no more messing around with PDFs and hundreds of emails all day long. Our risk team has a complete view of our current position, so they could sign off easily, and all I have to do is add money market funds to affect the change. So I can see that I can find Ultra and add the token, and it's done. Great. Hi, Evan. I'm back, and I've changed the terms. Do you want to allocate?
Yes, I'll do that right now. We're using the Liberia tokenization engine to issue Ultra tokens into our wallet. These are now going to be added to my collateral net asset pool. And with the schedule inclusive of these tokens, I can quickly run an allocation to cover this deficit.
Hi, I'm Sandy Call. I'm the head of FIRST, which is Franklin Innovation Research Strategies and Technologies at Franklin Templeton. So as we've seen the growth of more blockchain-based trading and blockchain-based moves to enhance the efficiency of the ecosystem, we're also starting to see growing interest in using tokenized money market funds as collateral. Initially, folks used stablecoins, and stablecoins are great because they can recirculate within the digital ecosystem. They can move from blockchain to blockchain, but there is uncertainty about what sits under a stablecoin. And in many jurisdictions, including the US, they are not yet a registered vehicle. Instead, we're seeing folks move towards tokenized money market funds, whereas money market funds have been a feature of the financial ecosystem for decades. It's really how we have managed dry powder and liquidity. And seeing these vehicles move into the tokenized space is creating a huge opportunity for us to really start to import some of the best of the traditional financial ecosystem onto these new crypto-inspired rails. So this is really starting to take hold. We're seeing rapid growth. And this idea that to the crypto natives, these tokenized money market funds look and feel like a yield-bearing stablecoin, but the regulatory certainty that underlies them and the established players that are beginning to offer these that have long reputations in the marketplace are both really helping to drive growth in the sector.
Well, that was easy. Since we moved our collateral agreements to smart contracts, we've not had to deal with paper and PDF contracts, and this has meant we've been able to make changes across multiple counterparties all day long with just a few clicks. What's been particularly helpful is the transparency of the data. It allows our risk team to make quicker decisions when we need to. It's quite the mess out there. The fortunate thing is we're now pricing our risk in with real-time price feeds. The unfortunate news is that one of our counterparties, Sterling Bank, has not been able to recover from the events of this morning, and they're now insolvent. Our risk team were able to calculate the closeout amounts within minutes as they had a complete picture of what has been settled right now. But I need to get in touch with our tri-party agent, Jan Grau at Euroclear. Can we speak?
Hey, Yalini, are you surviving?
Just about. It's been pretty straightforward until Sterling took a tumble this afternoon. I'm just calling to let you know we're issuing a notice of default.
Yeah, we've had a few of those already. I can see that the notice has been authenticated, so let's go ahead and start the process. And I'll let this run while my boss says a few words.
Euroclear's Collateral Highway is our neutral, open, and global tri-party architecture designed to deliver scalable, risk-controlled collateral management services. As a tri-party agent, we play a vital role in managing and mitigating counterparty risk. We ensure smooth asset substitution, default handling procedures, and the protection of all parties involved through robust operational frameworks and automation. We're committed to being the industry benchmark in service excellence, innovation, and client experience, supporting a unique and diverse ecosystem. Looking ahead, we see enormous potential in digital assets. They bring opportunities to unlock new sources of collateral, enhance accessibility, reduce operational friction, and bring greater certainty and transparency to the market. We're actively exploring how tokenized assets and DLT-based solutions can complement traditional models and create more efficient, resilient infrastructure for the future. We're excited to bring the expertise that we've built in collateral management into this next chapter of market evolution.
Hey, Yamini, you should see the collateral in your wallet now.
Thanks, Jan. The power of the immutable record provided us completely transparent information, which meant our risk teams were able to make immediate decisions. Also, we had immediate access to defaulted collateral so that we can now onward pledge the assets and manage our capital with more certainty on these tricky days. Chris, can I go home now?
Baby, baby, baby.
Christopher.
Oh.
Bieber. Home, Yardley. Margin Core is your home. Just stick around a little longer because you're doing such a fantastic job guiding us through this little storm. Well, I have to be honest, that was all a bit dicey, wasn't it? Not sure I would have invited you guys in if I'd known this was coming. But on the flip side, what a treat to see our app chain perform within a real life stress environment. So what did we learn? Number one, resilience. Maximize resilience. Resilience is the major takeaway here. At Margin Core, we see liquidity and operational resilience, and both stood firm today. Our liquidity resilience was protected via real-time inventory combined with instant tokenization and mobilization of digital money market funds. As gilts crashed, both Margin Core and our counterparties quickly reverted to alternative assets to stay solvent. Operational resilience was also robust. You see the automation of key processes such as eligibility amendments, token conversion, and asset settlement. This ensured that we met high volumes and sizes of margin calls to avoid any default events being called on us. Number two is closeout speed. Now, in the unfortunate event that a trading party does default, as we saw, we need transparency in our closeout obligations and acceleration in the processing. Via the digital app chain, we tick both boxes. Now, as the market transitions to the digital world, we will all have access to the highest levels of resilience that you've seen today. As such, event default should become even less common, a major industry win. So even I'm starting to fade. This is a far more dramatic day than I imagined. But for our last stop, let's fly across to New York head office to see how the guys are coping with the fallout. I'll see you shortly after a few hours sleep in the front coach, of course. Ta-ra.
Our final scenario takes us to New York, where the aftershock of London markets continue to unsettle Margin Core. In our current state, Margin Core would typically need to borrow against its credit line or settle overnight repo to raise cash.
Digital cash allows participants to settle intraday repo with near instantaneous settlement, removing delays associated with traditional bank processing times. This enables the financing of digital assets and crypto with any digital currency, providing further liquidity and optimization benefits.
And as more financing obligations move to clearing to support risk reduction, optimizing margin across CCPs becomes more critical to firms. Margin Core is currently over-collateralized at FICC, but has a deficit at NSCC. Currently, it is not possible to transfer assets directly from FICC to NSCC. Instead, cash must be delivered back to Margin Core before they can post it out to NSCC.
We show how moving collateral on blockchain can allow participants to instantly transfer eligible collateral directly between CCP accounts, further enhancing collateral mobility and liquidity. Digital cash is also posted to cover the remainder of the deficit with NSCC.
Let's hear from Margin Core's collateral management team.
Our job here in the New York region this morning is to make sure that Margin Core can maintain a capital buffer to defend any further hits to our balance sheet. We're going to have to raise some liquidity in the repo market. Now, we need to make sure that we can fund our cheapest assets, and at the same time, we only want to pay for what we need. Since we recently expanded our strategy to include Bitcoin investments, we'll want to use that Bitcoin in the repo process. So it's also important that we can find a counterparty who's willing to accept crypto. Looks like we've executed a 4-hour USD repo trade with Bravo Bank. Bravo will take JGBs and Bitcoin as collateral for the repo. The good news is, thanks to our new collateral app chain, we in the collateral department can now handle this process more efficiently than ever. To process this intraday repo, I can use the JGB and Bitcoin holdings in our net asset pool. I will use the allocate function to allocate these assets. I'll use all of our Bitcoin and then top it up with the remaining amount of JGBs to cover the obligation. There it is. Our price feed has been updated to include Bitcoin pricing, so the collateral is priced in real time. Now, given market fluctuations, we've agreed a target ratio on the collateral of 1.3 to prevent the need for multiple movements. Once this settles, the cash will be distributed to our wallet automatically. And for the cash leg of the repo, we're accepting digital cash from Bravo Bank. Our collateral app chain can handle many forms of digital cash, but in this case, that digital cash will be transferred using Finality Cash tokens. Let's hear from Michelle Neal, CEO of Finality.
A central promise of asset tokenization is faster settlement, and this means greater asset mobility, including on an intraday basis. A digital representation of central bank money is vital as an enabler for intraday collateral markets, enabling risk-free, real-time settlement and unlocking many profound opportunities, including intraday repo and active margining. So with intraday repo, we are enabling market participants to transfer ownership of cash and securities seamlessly via real-time delivery versus payment settlement with full flexibility around settlement timing. The creation of an intraday market will result in a large reduction of credit risk exposures by enabling settlement with atomicity, meaning that both legs settle or neither do. When combined with the wider digitization of central bank money in major currencies, as well as increasing tokenization of traditional assets, this stands to dramatically increase collateral availability, including from markets that have not been previously widely supportive. And with active margining, we're empowering participants to use cash as collateral on a broader basis.
Now that the collateral is allocated, the cash has been transferred to our wallet to complete the repo trade. The smart contract will automatically unwind this position in 4 hours. The day has progressed. It's 2 p.m. in New York, and MarginCore has managed to stay afloat through the day through constant vigilance and real-time position monitoring. Our risk managers are able to track their positions and monitor outstanding activities at all times. Recently, as our credit rating has been under some pressure, we've moved more trades to clearing to give comfort to our counterparties. Since doing that, we've been able to effectively manage our buffers with the CCPs. However, today is a different kind of day. We received a margin call from NSCC. Looks like I've got a big deficit here, but we're running short of US Treasuries and cash. I need to cover this exposure, but without cutting into our liquidity any further. Now, it looks like we're holding excess at FIC. Well, the clock is ticking, and we want to make sure we are optimizing everything we have, so we're going to move collateral across these CCPs to satisfy that obligation. That's something we couldn't do before. There's no need in this case to recall and then repost. I can move directly from one CCP to the other. To do that, I'll use the move function. Now, the from agreement is already populated, so I'll select the NSCC as the destination, and then move over enough treasuries to cover this obligation. I can see after the price and haircut are accounted for, that'll do it. Let's hear from Brian Steele, DTCC's head of clearing and security services.
Collateral, in many ways, is the lifeblood of the financial ecosystem. It enables market access, extensions of credit, the use of derivatives markets to hedge risk. If firms can't access collateral, they can't engage in markets. Today, a firm's excess collateral may become temporarily trapped, preventing them from fully participating in markets. They have good collateral, but such collateral may be divided across clearinghouses, counterparties, and custodians with different operating hours, business day conventions, and things like notice requirements for moving the collateral, which all makes the process of moving collateral from one location to another labor-intensive and time-consuming. It's also impossible to move collateral after hours, which may be more important as we think about markets moving and evolving to operate on a 24/7 basis. The opportunity to improve the model for our clients is a move to digital. Using tokenized forms of collateral, and just as importantly, creating a common collateral network connecting market participants could enable firms to lift unencumbered collateral, for example, US Treasuries at DTCC, and instantly pledge them to another CCP, for example, JSCC, even after US business hours are over. Such a network would allow firms to trade and manage risk when they need to, not when their access to collateral allows them to. Additionally, the use of smart contracts, which are highly programmable, could allow end users to create further automation of collateral movements, such as managing substitutions, ultimately reducing costs.
With those assets moved, the deficit at NSCC is covered, with no need to use up our cash or fund any additional collateral. Well, we made it through a rough day. Mr. Watts, what do you think about that? Mr. Watts? Mr. Watts!
Joe, you're a superstar, sir. What did he just say? If I heard you right, Joe, things are starting to settle down. I hope. That's very good news indeed. Hang on a minute. I see we have a message from John Vinci, our global treasurer. I know he is due to run a funding impact assessment for the day. Please, tell us some good news, JV.
Hi, Chris. I just wanted to leave you a message to review the day. We started the day in Tokyo where instead of having to pay to transfer collateral to make my obligations at JSCC, I simply posted excess treasuries we had tokenized. Moving over to Europe, I normally have to give before you get exercise to cover all of our UMR counterparties. But with this single box, which our tri-party agents have access to, the process is much easier and much faster. With regard to the credit event we had in London, we reached out to our counterparties, updated our schedules real time to include money market funds, which they gladly posted, so we're all good there as well. And also, we no longer have to free up collateral we post in order for it to be available for corporate action processing across record dates. That looks like it's going to be a big savings in time and liquidity. Because things were going so well, I wanted to ensure we were liquid as we closed in New York. So I did an intraday repo for a few hours using excess JGBs and Bitcoin we had against dollars. Don't think we need to do this on a regular basis, but good to know we can if we exhaust our buffers. Lastly, due to the volatility in the equity markets, I took the excess collateral posted to FICC and in real time shifted it to cover the increases we had at NSCC. All in all, very good day. If we continue down this path, I'm going to be coming back to you with new lower liquidity and buffer recommendations for these same businesses. Have a good night.
Boom, shake the room. Love you, Sir Vinci. What a splendid overview of today's events. So, we're in fantastic shape, guys, all things considered, especially. Despite picking the toughest day in history, we close out fully collateralized across all entities and obligations. Quite an achievement. Even under major stress, our digital collateral app chain stands up superbly. The power of digital collateral enabled us to make the right decisions for the business at speed, then execute upon them in real time. In turn, you saw this helped secure Margin Core's financial health and my job, I suspect. A big thank you to my wonderful team who, thanks to the technology that I enable for them, successfully found solutions to the big challenges today. It's been our absolute pleasure showing you the art of the possible. Now, time for me to take the guys out for a drink, and then I suspect we'll do it all again tomorrow. Let me pass to some of our key sponsors for a quick word before Nadine sums up and talks about the road ahead. Cheerio.
This collateral experiment is a milestone in the industry's journey toward the adoption of tokenization and digital assets. DTCC remains committed to driving purposeful innovation, solving real problems, and delivering value to our clients in the industry. We encourage our clients and partners to continue to work with us and collaborate to advance digital financial markets together.
Forming strategic partnerships with key industry players is essential to driving innovation and accelerating the adoption of transformative technologies. At Euroclear, We are proud to collaborate on real-world use cases that unlock the full potential of emerging solutions and tokenized financial assets. As a long-standing leader in collateral management across Europe, we are excited to continue evolving our capabilities in close collaboration with our clients, bringing trusted expertise to a rapidly changing market landscape.
Digital asset adoption continues to be a top priority for DTCC. That's why we're excited to see support for tokenizing securities gaining momentum. It's also why we're bringing market participants together to collaborate and coordinate on developing the digital asset ecosystem of the future. Today's collateral management experiment is the latest example of high-impact use cases that we're executing with our industry colleagues. As a strategic partner, DTCC is committed to creating a safe, efficient, and resilient market infrastructure for digital assets, just as we do for traditional assets. We look forward to continuing to work with firms to advance their digital transformation journeys.
Well, there you have it. That's our digital collateral experiment complete. So let's recap briefly. What were the highlights? We've optimized CCP, derivatives, and repo collateral in real time. We've mobilized assets across regions, leveraging a truly global collateral pool. So for example, we've settled US Treasuries in Tokyo within seconds while the US markets were still closed. We've also shown how tokenized assets can eliminate the need for record date substitutions. We've changed collateral eligibility real time within a stress event to include money market funds and protect ourselves from a default. We've shown how service providers and technology vendors will continue to play a critical role in the new world by plugging into the collateral app chain and leveraging a common infrastructure for all. We've offset CCP margin at DTCC to significantly reduce our margin requirements. And finally, we've used crypto collateral to cover repo exposure. It's probably obvious to all of you, but these are unprecedented scenarios for the market, and we've barely hit the tip of the iceberg. The digital collateral operating model is materially changing the way we do business, the processes we run, the behaviors we exhibit, and the benefits we realize. We are no longer limited by the inefficiencies of the TradFi world. So what's next? To be clear, the digital technology you've seen today will be available sometime in 2025 for production usage. The technology is actually not the critical factor on the path to industry take-up. But there are other foundations that the industry will need to lay out for the digital collateral operating model to become fully operational. These steps will in turn allow for critical mass uptake in coming years. So from now on, a major focus will be the advancement of the regulatory and the legal framework for the digital operating model to be operational. There is work to be done to ensure that regulators across all major jurisdictions are fully informed of the intricacies of the technology and data solutions that you've seen today. This will be a team effort, a partnership among all our participants. We will continue to work with Cleary in our legal working group to validate the robust legal frameworks that must govern the digital infrastructure, giving legal protection and recourse to all participants involved. We plan to host a legal roundtable in the coming months to provide you with the insights of the work done to date. In addition to market participants and regulators, we look forward to engaging with industry bodies as we need to coordinate and achieve consensus around data standards, best practices, all important components to encourage interoperability and adoption. And perhaps the most important point today is that we must continue to work together as an industry to advance at a pace towards productionizing the operating model. Only then will we realize all the benefits shown today. DTCC will continue to play our role as major infrastructure provider to bring the industry together and facilitate the important debate necessary to transform the industry. We will do so by leveraging the DTCC Digital Advisory Council. We will continue to listen to their opinion and feedback and collaboratively design the right solution to reach the right outcome. Thank you so much for attending today's digital collateral experiment. We hope you've enjoyed both the content and the demonstration. We see this as a key industry milestone for the digital collateral movement, taking us a step closer to our mutual goal of a digital-first future. As you've heard us say already, the digital benefits are both extensive and accessible. Now it's up to us as an industry to realize them by collaboratively executing on the right operating model. Please watch out for further updates from DTCC on related events, working groups, and InfoShare. We do live in exciting times, and we hope you'll join us on this amazing digital journey. We do hope to see you all soon. On this amazing digital journey.